Good morning, ladies and gentlemen, and welcome to the Loungers PLC investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard, and we will notify you by email when these are ready for you to review. I'd also like to remind you that the presentation is being recorded. Before we begin, I would like to submit the following poll. I would now like to hand you over to Gregor Grant, CFO, and Nick Collins, CEO. Good morning, gentlemen.
Good morning. Good morning. Good morning, everyone. Thank you very much for joining us. My name is Nick Collins. I'm Chief Executive of Loungers. I'm going to take you through a few slides and I will then hand over to Gregor. And as mentioned, this is an introduction to Loungers, and just to be clear, the presentation doesn't include any new financial information. So looking at slide 2, which is an introductory slide, Loungers we're an all-day cafe, bar, restaurant business, and we operate under 2 brands. The Lounge and the Cozy Clubs, and I'll come on and talk about those in a little bit more detail. We currently have 182 sites across England and Wales, so we have 151 lounges and 31 Cozy Clubs. And actually this week we're opening a further 2 sites, so we're opening in Colchester and St Neots lounges, so we'll be up to 184 in a couple of days' time. The business floated in April 2019, and at the time of the IPO, when we were doing our roadshow, we were talking a lot about our 5-year track record of sector outperformance. That's what we were telling investors about, and how we delivered sector-leading like-for-like sales growth, we delivered sector-leading margin improvement, and we'd done that at the same time as opening in excess of 20 sites a year. I think that was a really important message at the time of the IPO. Yes, we're a rollout story, but for the 5 years preceding the IPO, we've been opening in excess of 20 sites a year, so it was nothing new to us. As I said, the business floated in April 2019, and then we had 11 months where we were given the opportunity to demonstrate to our investors and to the city that we could deliver on our IPO targets, and we were doing that. We were delivering from a sales perspective, and we were delivering the new site openings. And then obviously at the start of 2020, COVID hit and the world changed rather dramatically. I think one of the things we're really keen to focus on today is what the business looks like post-COVID or coming out of COVID. And if you look at how the business has performed from a sales perspective, both last summer when we were allowed to trade and since May the 17th this year when we've been allowed to trade, we've had a sector-leading like-for-like outperformance. And our businesses and our brands certainly look more relevant than ever. And the behavioural changes that we've seen as a result of COVID have suited the company very well. We recognise now as an opportunity to accelerate from the 25 new site openings per annum that we talked about at the time of the IPO, if we think it's the right thing to do. And we also believe that the scale opportunity has been enhanced. I think at the time of the IPO and consistently for the last 8 or 9 years, we've talked about there being scope for 400 lounges and 100 Cozy Clubs across the UK. I think we firmly believe those numbers are very, very conservative now. So moving on to slide 3, which talks about the bigger brand Lounge and what are the lounges and what differentiates them. And the lounges are the neighbourhood cafe bars, which combine eating out, the British pub, and coffee shop culture. And we serve a very broad demographic appeal. We refer to the business as being democratic or ageless and classless. And it's really hard to speak to this on Zoom or showing videos or using slides, etc. But if you walk into a lounge at any time of day, you will see people from all different walks of life. You'll see school children, students, mums and babies, businessmen, builders, grandparents, large groups, small groups. Every walk of life is represented. And we operate in secondary suburban high streets and small market towns. And it's really critical, I think, to understanding the potential scale of the lounge business in being able to picture those high streets where we trade. A lounge will typically be alongside one or two high street banks, a Costa Coffee, maybe a Greggs, Holland and Barrett, and a couple of independent pubs, maybe a JD Wetherspoon, or maybe one of the pizza operators, the national pizza operators. That's the environment where we trade. And I think from a competitive perspective, when you look at lots of casual dining businesses, etc., and other restaurant chains, they operate in they can't operate in such small high streets, and as I come on to talk about, that really helps understand how we achieve such consistently strong returns on capital. So we have an all-day offer, and we serve the same menu from 9 o'clock in the morning right the way through to 10 o'clock at night. So you can come into a lounge and use it for multiple occasions. So you might come in for a coffee, you might come in for breakfast, you might come in for brunch, you might come in for a sandwich at lunchtime, you might come in for a bigger lunch, a glass of wine in the afternoon, a cup of tea and a slice of cake in the afternoon, cocktails or pints in the evening, or an evening meal. So it's a genuine all-day offer. And I think if you look at the charts on the right-hand side of this slide, you can see that represented. So into 18% of our sales in the morning, 48% in the afternoon, and then 34% in the evening. So we're generating revenue right away across from 9 in the morning through to 11 or 12 o'clock at night. And really importantly, we're generating decent levels of revenue in the shoulder periods, either side of the main meal times. And then looking at the chart beneath that, which looks at the sales mix between food and drink, 56% of our sales are food, and 14% of our sales are brunch. So brunch is a really important day part for us, pre-midday. 28% of our sales are alcohol, so we're not overly reliant on alcohol, but alcohol is an important part of what we do. And then 10% of our sales are coffee. Again, and I think that's a really important aspect of our trade. And then one more statistic, 47% of our sales are generated between Monday and Thursday. And so what you don't see in the lounge business, nor in the cozy club business, I'll come on to talk about, is you don't see an over-reliance on those peak weekend and evening shifts, Friday, Saturday daytime, Saturday night. Not only are we generating revenue right the way from 9 o'clock in the morning through to 11 or 12 o'clock at night, but we're doing that 7 days a week, right the way through from Monday through to Sunday. And operating in this environment, operationally, it's complex. And we believe it's a big barrier to entry. So when you walk into a lounge, it's much like a pub in that you can either go to the bar and you order at the bar, or in a more recent innovation, you can sit down at your table and you can order using our order at table app. And what that means is, we don't have any control over the flow of customers and the flow of orders into our kitchen. So we have a big menu, it's all freshly prepared, and so that places a lot of pressure on our kitchens. Unlike restaurants, we don't take reservations, so we can't control the flow of tickets into that kitchen. And one of the things we've seen a number of bigger operators try and replicate what we do. And I think that you can replicate to a degree the look and feel and the design of our units, but replicating our ability to deliver it and to deliver it at a decent margin, I think is very, very challenging. We're not tied to any particular cuisine. Again, I think that's really important. I think if you look a few years ago when kind of barbecue and pulled pork, etc., was all the rage, we could put that on our menu, and we did. And then it turned out that was a trend that was relatively short-lived, so we were able to remove it from our menus and react accordingly. So not being tied to any particular cuisine, it means we can always try and adapt, evolve. We're always looking to see what's going on in London and elsewhere in the country, and we try to stick on the shoulder of trends. And value for money is a really important guiding principle within the business, and it's something we've had lots of opportunities over the last 5, 6, 7 years to take price, and we haven't taken price. Our sector-leading like-for-like sales performance has consistently been volume-driven, and I think that's a really important factor in our continued appeal across all of England and Wales. We have informal, quirky interiors, and lots of people refer to the business as being, or the lounges as being, a home from home. Each site is individually named and designed, and no two sites are the same. There's constant design evolution. Atmosphere is really important to what we do, but also we're not a cookie cutter model, and that's, again, I think it's absolutely critical. When we design a site, when we name a site, we'll have lots of references to local community. And it's, I think, if you consider awareness of the lounge brand as such, I think taking Birmingham as an example, we have 10 or 11 lounges in the suburbs of Birmingham, and people, if they walk past a lounge, they'll recognise that there are similarities to other lounges that they've seen in Greater Birmingham. I don't think people necessarily view us as a national business with 150 odd lounges across the UK. They probably think it's a business that's local to Birmingham. And hospitality and familiarity really are very much at the core of everything that we do. It's a really important factor in our continued sales success. And we have a very independent culture in the business, so quite strong non-corporate, non-branded ethos. And as I said, there's a real focus on the local community. The lounge needs to belong to that community. It's their place, and it needs to earn its place along that high street. And as 90% of our customers visit for multiple occasions, so that's a really strong statistic. And again, I think if you think about that competitive landscape where the lounges operate, that typical high street, if someone opens, if a coffee shop opens alongside us, they're competing with 10% of our revenue. Whereas if we open alongside a coffee shop, we're competing with everything they do. The same applies to a local sandwich shop. The same applies to a pub. And so it puts us in a really strong position. Moving on to slide 4, and the cozy clubs and what they are and what differentiates them. And I think it's important to understand why we have the cozy clubs. Why did we develop the cozy clubs? And I think there are two principal reasons here. I think one was that as we looked at city centres and the larger market towns, we recognised that there was an opportunity to generate higher levels of sales, higher levels of unit EBITDA in sites with a bigger footprint. And I think that, alongside the fact that the informality of the lounges, we didn't feel was quite as appropriate in those sorts of locations. And so that led to the evolution in 2010 of the cozy clubs, which are more formal bar restaurants. And the biggest two differentiators are that you can reserve tables at the cozy clubs and that we provide table service at the cozy clubs. So unlike the lounges where you either order at the bar or like a pub, or you order using the app, at the cozy clubs you'll be visited at your table and someone will take your order. But there are really important similarities to the lounges. Critically, it's an all-day offer. So much like the lounges, we're generating revenue right from 9 o'clock through to 12 o'clock or 1 o'clock at the cozy clubs. And again, the focus on hospitality and culture is really, really important. And I think if we consider coming out of the lockdown and reopening in May of this year, I think it'd be fair to say we're slightly more nervous about how the cozy clubs would perform being in city centres. I think we always knew, and certainly from our experience last summer, we knew that the lounges would fly, and that's exactly what they did. We were a little bit more nervous about the cozy clubs, but they've actually performed fantastically well, really consistently, right from day one and reopening. And that wasn't a kind of blip reflecting pent-up demand. It's been consistent since May, and it's continuing to this day. They're actually marginally outperforming the lounges. And I think that really speaks to the all-day offer. I think it also speaks to the pitch of the cozy clubs. We benefit. It's really important when we're looking at both lounges and cozy clubs, when we're looking at pitch and considering where we want to trade, being sufficiently close to both retail footfall as well as leisure footfall is really important. And so we capture all the day parts. So as I said, the cozy clubs are typically located in city centres and large market towns. We tend to go for larger and more theatrical buildings. We've got quite a few former banks and really beautiful period properties. And we want to create a sense of occasion and a sense of discovery. And I think that's very much reflected in how the cozy clubs are used. And lots of people use them for celebrations. So we'll see bigger groups quite often celebrating, whether that's anniversaries or family reunions, etc. And that's reflected in the sales mix, which you can see on the right-hand side there. So there is a slightly stronger bias towards alcohol there's a slightly stronger bias towards the evenings and the weekends, albeit it's still very much a genuine all-day business and still generating revenue right the way across from Monday through to Sunday. And we often use first floor space. I think that really helps create that sense of discovery, and it also helps from a rent revenue perspective. And what the cozy clubs allow us is an opportunity for greater coverage within an individual city. So using the example of Birmingham again, but this is true of lots of cities across the UK. In Birmingham, we have 2 cozy clubs in the city centre, and then we have 10 or 11 lounges across the suburbs. Slide 5 talks about COVID and how we believe we are uniquely well placed as we're coming out of COVID. I think the first point to note here is that we've used the lockdown periods well. And I think if you think back to March 2020, and it was, for our teams, it was a very uncertain time. As the government were asking people not to visit bars and restaurants and cafes, etc. And our 5,000 employees were worried about their livelihoods. And I think the fact that we looked after our teams and we adopted an approach of regular, honest communication with them throughout this whole period, that's really helped strengthen the culture in the business, and that's put us in a much stronger position as we've come out of COVID. We've constantly focused on evolution and innovation. And again, I think once we'd got to grips with that very first lockdown, and we kind of classify in buckets in terms of, right, number 1 priority is we need to look after our team. I think number 2 priority was engaging with the city, engaging with the institutional investors and our brokers, and understanding attitudes towards liquidity, and we carried out the placing. I think once those 2 were achieved, it was a case of we've got this really unique opportunity when we're not trading and we're not opening one site every 2 weeks, which is what we've been doing for the last 5 or 6 years. How can we use this time well? And that we really focused on evolution and innovation. I'll come on and talk about a couple of aspects of that in a minute, but I think that put us in a really strong position as we've come out of COVID. And we also invested in our estate from a maintenance perspective and catching up with lots of work that might otherwise have led to brief closure periods when we were trading. And critically, I think we really embraced the social distancing challenge. I'm sure many of you will have been to lots of other leisure operators over the course of the last 18, 24 months and been confronted by lots of clipboards and lots of perspex and lots of instructions and red tape. And our attitude was very much, it's really important. Yes, we have to adhere to these regulations in terms of distancing, but our customers want to eat and drink in a safe, but still a really enjoyable atmosphere and a hospitable atmosphere. I think our approach to that is a big factor in explaining why we continue to outperform the rest of the market so strongly. But there's no doubt we're well protected against the longer term behavioural changes that have been brought about by COVID. If you look at where our sites are located, we're not exposed to large office communities, we're not exposed to transport hubs, and we're not exposed to international tourism locations. And that's clearly protected us a great deal. We are typically located in residential areas, and we have benefited, I think, from moves to working from home. I think it's important not to overstate that too much. You won't go into a lounge or a cozy club and see dozens of people on laptops or holding meetings. But I think as a result of people perhaps having more time at home, they still need to go out for brunch, they'll still need to go out for a coffee. And if they're finishing work earlier because they're not commuting perhaps so frequently, then that gives them the opportunity to go out for tea with their family. As I said, we've consistently outperformed the market by around 30% since reopening post-lockdowns 1 and 3. I mean, we've always outperformed the market. And again, that was one of the very strong messages that we talked about at the time of the IPO, but that outperformance has now significantly increased. And I think that speaks to both the work that we did during the lockdowns, and it really speaks to the relevance of our brands coming out of COVID. And I talked about two areas where we did a lot of work during COVID, and we've increased sales, efficiency, and margin as a result of 2 major lockdown projects. I think one of those was the introduction of the web-based order at table app, which has allowed our customers to order a lot quicker, and we've seen a real increase in average spend. And secondly, the reduction in menu discounts, and I don't think that's a permanent change. I think it's something that we will see nudge up as we kind of evolve from COVID. But it's allowed us to learn about our kitchens and how we can deliver food more efficiently and more quickly and have quicker ticket times. So starting to think about property, and slide 6 talks about the rollout and pipeline. So since the start of this financial year, we've gradually returned to 4 build teams fitting out sites. And that's quite important. So we're quite unique in that respect, in that we fit out our own sites. So we have 4 build teams. We are effectively a 25 million pound a year construction business. And doing that ourselves, it adds complexity into our business, but absolutely critically, it provides us with real flexibility and speed in terms of being able to react to problems and open sites, and also it allows us to open sites efficiently and achieve stronger returns on capital. So we've opened 14 sites so far this financial year. We anticipate opening 23. And importantly, and this was one of the big messages we've talked about this summer, is we're back up to our pre-COVID run rate of 25 sites a year. We're back delivering the strategy that we set out at the time of the IPO. However, one of the projects that we did during the lockdown, particularly the most recent lockdown at the start of this year, was having a really thorough review of our build and our property structures and processes, and putting us in a position to maximise future opportunities in terms of achieving CapEx efficiencies, importantly. So Eve Bugler, who joined us as COO at the end of last year, she's been looking at this in a lot of detail. I think we recognise, yes, there are inflationary pressures on the build side of the business, but equally, we believe we can be more efficient, I think, particularly in terms of how we purchase and how we manage labour. Also, in terms of internal development and progression on the build side of the business, it's something that we're very focused on the trading operational side, but it's something we want to focus more on the build side. And finally, and probably most importantly, providing capacity to accelerate the rollout to in excess of 25 sites per annum, should we choose to do so. And I think that's something that we feel confident we could do when we believe the time is right. Our pipeline is probably unsurprisingly in exceptionally good shape, and it's important to note that it was in very good shape pre-COVID, and that's been the case again for the last 5 or 6 years. As a business, Lounges has never struggled to find sites, and we've shown enormously consistent property discipline. I think our rent to revenue ratio of around 5.6% is the lowest in the industry by some distance. And we achieve that by walking away from opportunities if the financial parameters aren't right. So we continue to see excellent opportunities. Our bread and butter, what we typically do is we convert A1 retail sites to A3 use, so we can open lounges and cozy clubs in those. So we get asked a lot about casual dining CVAs, and whether that provides us with lots of opportunity. And I think COVID has seen a continuation and an acceleration of the closure of a lot of casual dining businesses, which has taken supply out of the market, which will indirectly probably benefit us from a customer perspective. But we don't typically go into those sites. A small exception to that, where we took on 4 Pizza Express sites early this year. But we took advantage of that CVA process, but that's not typically what we do. What we typically do is we open in what might have been former M&Co's or Mother Cares or any other retail businesses. And one of the things that we've seen, I think we saw over COVID, is we've seen better quality opportunities come available as a result of CVAs. So a good example of that might be the Arcadia CVAs, where we've seen some fantastic opportunities. And what we're seeing is we're not necessarily seeing headline rent reductions, but what we are seeing is better pitch opportunities come about, and that's allowing us to open more top quartile lounges and cozy clubs. And what I mean by that is we've got a long list of target locations, where in St Neots being a good example. So we're opening in St Neots in the next couple of days. Over the last 5 or 6 years, I've seen a number of opportunities in St Neots none of which have been quite right. We've always known exactly where the best pitch in St Neots was. And then over the course of the last 18 months, as a result of the CVA, the Dorothy Perkins site became available. And we immediately knew that was the best possible location for us to look at to open in St Neots. And so, as I said, what we're seeing is we're able to open more top quartile sites. We're able to increase the average level of unit EBITDA and the average level of revenue across the business. And we're also seeing, I think, an improvement in the overall landlord package that we're securing on property. And that's a combination of both rent-free period and capital contribution from the landlord. And our pipeline for year-end April 22 is now complete. And we're placing sites, well, H1 of FY23 is complete, and we're looking at H2 of FY23, and indeed H1 of FY24 now. And that pipeline strength that I've talked about, it's reflected in the quality of sites that we've opened more recently. And if we turn to slide 7, this just gives 4 examples of recent openings, and I promise I haven't cherry-picked the best 4. But what these 4, I think, hopefully show is they show 2 things. One is one of the points I was just making in terms of how strong our recent openings have been. I think, secondly, they also show the diversity of the types of locations where we can open lounges. And that really helps understand the potential scale of the lounge business. So looking at them in turn, in the top left there, Largo Lounge in Rushton Lakes, which opened in March 2020, which was a slightly ridiculous time to open a site. I think we traded for 6 days before we were closed down as a result of COVID. Rushton Lakes is a mixed-use leisure retail scheme. It's been enormously successful, and we don't. It's not our typical lounge type of location. Here we trade alongside many other casual dining operators, quick service restaurants. There's Five Guys, there's Bill's, Wagamama. There must be a dozen other operators alongside us. And that level of competition really has no impact on our levels of trade. And you'll see from the revenue numbers. So the revenue numbers here, average weekly gross sales across the number of weeks that the sites have traded during this financial year. And you can see there 47,700 at Rushton Lakes. So that's definitely a top 10 lounge site. It's got a great rent to revenue ratio of 5.6%. And as I said, those types of locations aren't our bread and butter. But I think we recognise that where those schemes perform very well, and then they represent a good opportunity for us. Moving across to Sittingbourne, again, we opened here in October 2020, which was, again, it was just when lockdown 2 was appearing on the horizon. Lots of those ridiculous rules around substantial meals and curfews, etc., and rule of 6 were in place. And again, it was a very uncertain time to open a site, but it was ready to open, so we felt it was the right thing to do. And we've performed fantastically well there. Again, sales of 37,300, a rent to revenue ratio of 3.5%, which is clearly very, very strong. And Sentado is really interesting from a pitch perspective. We're really well located here, in between the train station, so we benefit from commuter footfall. We're very close to the cinema, and then we're nicely linked with the traditional high street. So we're benefiting from retail, leisure, and commuter footfall. Bottom right, Blackpool. This was one of the Pizza Express sites I mentioned earlier. We opened in June of this year. And the sales of 43,000 average over 19 weeks. There'll be a degree of seasonality in there, and it will be a seasonal site, so we expect it to perform a lot stronger in the summer than it will in the winter. And as a business, lounge and cozy club, we perform really strongly in the coastal locations. And it's something that we absolutely look for when we're looking at property opportunities. And I would strongly expect next summer, when this has had an opportunity to really hit the ground running and trade from the start of the season, this will be one of our top performing lounges. And then bottom left, Welwyn Garden City, Pastino Lounge, which we opened again in May of this year. Average sales of 28,400. Commuter town, more affluent, a bit closer to London. And so hopefully across those 4 locations, you can see you can see the diversity of the types of places where we can locate lounges. And as I said, I think that speaks to the potential scale of the opportunity. And then just looking at that, the stat there at the bottom. So lounge gross average weekly sales over the 24-week period we're talking about here were 28,200. So you can see Welwyn Garden City was very close to that, but the other 3 sites there were significantly ahead of that. And I just reiterate that point. I think, we're really pleased with the strength of the pipeline, really pleased with the property opportunities, and it's enabling us to open more top quartile sites and increase that average level of unit EBITDA. So enough from me. I'll flick slide 8 and hand over to Gregor.
Thank you, Nick, and good morning. I've got a number of slides here that touch on financials and sort of recap on some of the points that Nick made about the strength of our trading performance post the end of lockdown 3. Then I'll touch on some of the key metrics which the management team use in terms of assessing the business, and that gives me an opportunity to talk a little bit about margin. And then finally, I'll wrap up with looking at the net debt position and how that has moved over the course of coronavirus and bring you up to date on that. So on slide 8, looking at trading post reopening, we with our AGM in the middle of October, we announced a trading statement there which reported that our net like-for-like sales were 26.6%, plus 26.6% over the 20 weeks from the 17th of May to the 3rd of October. So those were the 20 weeks when we were able to trade internal and external. That reported 26.6% reflects and includes the positive impact of the VAT reduction. So that reduction in the VAT rate from 20% to 5% on food and non-alcohol. And as we've done in previous reporting periods, we've split out the impact of that VAT reduction. So we can see that the plus 26.6% headline number includes a 13% benefit from the VAT and gives you an underlying like-for-like sales performance of plus 13.6% over those 20 weeks. And that's comparing the 20 weeks in 2021 to the same 20 weeks in 2019, so pre-COVID. And that's plus 13.6, obviously a stronger performance than we reported in the period post-lockdown 1, when we were minus 1.1% underlying like-for-like sales. And it very much, I think, reflects a more confident consumer coming out of lockdown 3 than out of lockdown 1. It certainly took 2 or 3 weeks, we found, after lockdown 1 for our sites to recover to pre-COVID levels of trade. And when we look at what's driven that plus 13.6% underlying performance, significant contributors are certainly the fact that we've seen strong growth in the early day parts and the shoulder periods. So you've seen effectively a lengthening of the trading day. Our staycation sites, particularly those in the southwest, as you can imagine, have traded very strongly over the summer holidays. And likewise, those sites where we were able to invest in our external areas or to take advantage of relaxation of local council rules and put more covers outside have certainly benefited during the summer period as well. And I think, as Nick said, possibly the one area that was a slight surprise has been the strength of that Cosy Club city centre and large town trading performance. Certainly an area where potentially we were slightly more nervous coming out of lockdown 3, but as Nick said, they've actually sort of marginally outperformed the lounge business over those 20 weeks. Looking on to slide 9 and looking here about how, I guess, management monitor the financial performance of lounges, focusing on 3 key metrics here, the first of which is like-for-like sales, which of course we've just been touching on. And of course, the ability to grow sales is absolutely critical to growing profitability. Pre-COVID, the business had a very successful track record, delivering circa 6% annual like-for-like sales growth over the years from FY17 through to FY20. And really importantly, when you look behind that 6% like-for-like sales growth, it was very consistent across all of the age cohorts within the business. So it wasn't a case of the new sites, driving that like-for-like sales performance. If you look back to sites that were opened in 2013 and earlier, they were showing very similar levels of like-for-like sales growth. And secondly, and equally importantly, when you look at what makes up that like-for-like sales performance, it's a combination of volume and price. And typically, if we're looking at 6% like-for-like growth, 4% or so would come from volume and 2% from price. And price is hugely important to the business. Those value for money credentials are a key principle. The second metric, which is key, is the adjusted EBITDA margin. And you'll see in our financial reporting that we show that both under IFRS 16, so the new accounting standard for leases, and the old standard IAS 17, where the lease is shown as an operating cost. And it's probably fair to say that internally, we look at the business very much on an IAS 17 basis. We look at our P&Ls with rent as an operating cost. We're very focused on site profitability post-rent and on returns on investment post-rent. Adjusted EBITDA we define as being EBITDA before exceptional costs, before share-based payments, and before pre-opening costs. And clearly within the business, the ability to deliver margin expansion is absolutely critical. So it's all right, very well growing your like-for-like sales, but we need that to be accompanied by margin expansion as well. And when we look at the ability of the business to expand its margin, I think there are three key areas. Clearly, the increasing scale of the business as we open new sites provides us with operational leverage and the ability to share that central cost base over greater sites and to drive EBITDA expansion that way. Secondly, and also linked to our increased scale, clearly, is the ability to renegotiate inbound costs, particularly in respect of food and drink supplies, for example. And in late 2019, we renegotiated both our food and drink supply contracts, and we've been enjoying the benefit of that improved pricing throughout FY20 and FY21 when we've been able to trade. Currently, we're just starting a project to look at the opportunities for us in terms of consolidating our distribution. At the moment, it's a case of our sites typically having, 3, 4 or 5 deliveries a day. If we can move to a system which would see, 1 delivery a day, preferably in the middle of the night, that has to lead to significant benefits in terms of efficiency and indeed environmental benefits. Clearly, there's a lot of talk at the moment about the current inflationary environment and the cost challenges that the sector is facing, and we're working hard to manage those challenges. I think what we're experiencing in terms of food and drink inflation is it is really very much in line with our normal experience. There's an element of hedging within the business, but typically you're looking at, for example, produce will be priced twice a year for the summer and winter seasons, so you have clarity 6 months out on that. Dairy and meat is repriced every 3 months, so you have 3 months visibility on that. And typically the drink contracts are fixed over the 2-year period of the contract, subject to duty changes. In terms of labour costs, we've got a track record of dealing with 5% increases on an annual basis in the national living wage, and we'll continue to monitor and manage our labour costs tightly. And then finally, in respect of utilities, we managed to fix our utility costs back in May 2020. Right through to September 2024. So we're in a very comfortable and good position as regards our electricity and gas costs. I think the third key metric probably to focus on is operating cash flow. And clearly that's absolutely critical given that our strategy is one of rolling out and growing the estate significantly. Our operating cash flow does benefit from the benefit of negative working capital. So as we deliver positive like-for-like sales growth and we roll out new sites, we see the positive benefits of that on our cash flow. And indeed, in terms of funding our new site rollout, we're now in a position of being self-funding. If you think of a position where we're looking to open, say, 25 new sites in a year, if that's 20 lounges and 5 cosy clubs, that's a capex cost for those new sites of approximately 19 million. And then with additional maintenance capex and splash and dash capex investment, we're probably looking at spending approximately £25 million a year on capex. And so making sure that we generate that level of operating cash flow to be self-funding is absolutely key. Clicking over to slide 10, if I may. This really just brings you up to date in terms of our net debt position, excluding IFRS 16 property leases. And the chart on the left-hand side really just takes you through, I think, the peaks and troughs of our net debt position as the company has moved in and out of lockdowns. I think that the key points clearly are that the balance sheet strength of the business has been maintained and enhanced through the COVID experience. Clearly, we've benefited from the equity raise, which we undertook in April 20 to raise just over £8 million. But equally, we've benefited significantly from the level of government support, in particular that VAT rate reduction and the suspension of business rates. And that's very much allowed us to come out of COVID with the balance sheet in a stronger position and lower net debt than before COVID. Underlying net debt in the third column of the table peaked at 47.5 million coming out of lockdown 3. I think it's fair to say that we were much more confident in lockdown 3, having experienced previous lockdowns about how strongly the business would trade coming out of it. And on that basis, we provided significant support to our trading partners to make sure that they were equally protected. And what you see coming out of lockdown 3 is a very significant reduction in net debt as we're allowed to trade again, both externally and internally. So at the 3rd of October, at the end of the first half, headline net debt was down to 11.9 million, and then underlying net debt, which includes £5.5 million of deferred COVID-19 liabilities, which are essentially rent and an element of VAT due to HMRC under a repayment programme. So underlying net debt down to 17.5 million, and therefore underlying net debt reduced by just over £30 million between April 21 and the beginning of October 21. And on that basis, if I may, I'll hand back to Nick for one or two concluding comments.
Yes, just looking at slide 11 and how do we create value? And we are genuinely differentiated at All Day Operative with broad demographic appeal. And I think one thing that I probably meant to say earlier and didn't is that if you want to understand what we do, the very best way of doing it is by visiting the sites. It's so much easier to understand rather than listening to Gregor and I talk about it or pictures on slides. But we are genuinely differentiated, and that all day aspect is absolutely critical to it. It's a value for money offer with many flexibility, and we have no single competitor. We get asked quite a lot about JD Wetherspoons, and they are an all-day offer, and they probably are the only other real all-day offer. But I think we're targeting quite different demographics. We have different price points. But I think it's useful looking at JB compared to JD Wetherspoons in some respects. They have an estate of approaching 900 pubs, and I think when you think about the potential scale of the lounge business, then that is a really useful comparison. We do have a track record of sustainable like-for-like sales outperformance, and as hopefully we've demonstrated, that's clearly been enhanced post-COVID. And that suburban secondary high street focus allows the sub 6% rent to revenue ratio, and that helps us generate fantastically consistent returns on capital. It's a self-financed rollout with the potential to accelerate post-COVID. And we believe there's significant new site opportunity. Again, we've talked about 400 lounges and 100 cozy clubs, but we believe those numbers are conservative. Consensus FY24 forecast revenue is now 286 million, which I think helps kind of demonstrate the potential scale of the business. And as Gregor's highlighted, there's real opportunity for margin expansion as the business continues to grow. So that concludes the presentation. I meant to do a wrap up. I think I'll wait till I'm asked to do that.
Yeah, indeed. Gregor and Nick, thank you very much for your presentation today. Ladies and gentlemen, please continue to submit your questions using the Q&A tab situated on the top right-hand corner of your screen. But just while the company take a few moments to review those investor questions submitted already, I would like to remind you the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. I would also like to remind you that your feedback is very important to the company, and immediately after today's presentation has ended, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. Gregor, Nick, we've received several pre-submitted questions from investors today, and I wanted to start off the Q&A session with these, if I may. The first one reads, can you expand on the pipeline of new sites? What do you look for in terms of location and quality?
I'll take that one, I think. So, I mean, as we talked about during the presentation, the pipeline is in very good shape, and we're often looking. And this week we'll be looking at sites which we're likely to open in 18 to 24 months' time. And so, managing pipeline is really important. In terms of what we look for, I mentioned we typically convert retail premises. And so I think big, wide frontage is really important. Lots of glazing, which we like to convert to sliding folding, so we can bring the outside in. It's really important that our sites are kind of very light and friendly. And over 60% of our customers are female, and so being a safe environment is really important. We like period property. We like interesting space. It's, I think, both lounge and cozy club, they're more interesting if they have a few twists and turns rather than just being a big rectangle. From a pitch perspective, as I mentioned, getting that right balance of retail footfall and leisure footfall, and understanding how a community works is absolutely critical to our continued success. Over our 20-year history, we've closed 6 sites. 2 of those were sites that were at the end of their leases, and they were just too small, and we decided not to continue. So you could argue that out of the 188 sites we've opened in total, 4 of them have been mistakes, and so our track record is pretty bloody good. And even saying that, the 4 mistakes really hurt. But we've been doing this for a long time now, so our knowledge of target locations is really good. And Tom Trenchard, our property director, and his team, they spend a lot of time out on the road looking at opportunities and assessing opportunities. And I think it's a real strength of the business.
Thank you for that. The next one reads, what KPIs should investors use to measure the performance of your estate?
I think I'll take that one, if I may. I think the sort of opening comment probably is that clearly COVID's presented quite a number of challenges for anybody trying to interpret financial performance, and the combined impact, I guess, to the downside of the lockdowns and on the positive side of government support measures, be it the VAT reduction or the rates reduction. So I think in terms of understanding our underlying performance, hopefully, if you look at the presentations which we use to accompany our preliminary and interim reporting, we endeavour to show bridges which will compare our performance in the COVID environment to a pre-COVID environment. But in terms of I guess the key metrics, obviously I touched on 3 of those earlier, being like-for-like sales, adjusted EBITDA, and operating cash flow. But I think another couple which are particularly worth focusing on in terms of understanding our performance at site level would be, I guess, firstly looking at the gross profit as presented in our financial reporting. So that is a gross profit number which is looking at site sales, less site labour, and less site cost of goods sold. So that gives you a really good idea as to how we're growing our site margins. And we're managing, for example, with the current inflationary environment. And then the second one that's probably worth looking at, and Nick touched on it a minute ago, is our rent percentage, and looking at the way in which our financial accounts, we bridge the IFRS 16 to the IAS 17 number, so you can identify our rent spend. And then again, looking at that rent as a percentage of revenue, which typically is circa 5.5%, and again is a really key feature of the business and its profitability.
Thank you for that. The last one of the pre-submitted questions reads as follows. Have you experienced issues in attracting and or retaining staff?
Yes, I think is the short answer, but provide some context, I think. But that's always been the case, particularly in respect of chefs. It's always been hard to attract and retain chefs, and if you look at what's happened post-COVID, it has got a little bit more difficult. I think it's got more difficult in certain locations. We found over the summer, in particular, in coastal locations and where staycationing was really buoyant. It was very challenging, and I think that's eased off somewhat as we've come out of the summer. And there's 2 things at play here. I think firstly Brexit, but to be honest, that hasn't really affected us that much. Pre-COVID, around 10% of our team were EU nationals. That's probably decreased a little bit. But where Brexit might have had an impact is in terms of in London, if the pool of EU national chefs has decreased, and they're obviously putting more UK chefs, and they're putting them from outside the capital, and that's obviously then having a knock-on impact on us. I think what's probably more of an issue is the fact that a portion of people who work in hospitality during the various lockdowns were exposed or given the opportunity to work in other sectors. That might be delivery, it might be retail, where they found the work easier, the pay potentially a little bit better, the hours more sociable, and that made them think about which sector they wanted to work in. And I think it's on us and the rest of our sector to make sure that we're doing everything we can to talk about what's really good about working in hospitality and the really fun social side of it, the amazing career opportunities that we can provide. And I think if you think about lounges, I'd say two things. One is we're really proud of the culture within the business, and because of our rapid growth, we're really proud of the careers and the opportunity that we create for people. And there's dozens and dozens of examples of people who've risen dramatically through our business because they've performed well and because of the opportunities that our growth creates. And so, yeah, I think that's a really important factor. And I'd also talk about, we've opened a number of sites this year. Every time we open a site, we have to find between 25, 35, 45 people to work in those sites. And we're opening sites, and and hopefully that demonstrates that yes, it is a little bit more challenging, but it's not impossible.
Thank you, Nick. Gentlemen, investors have submitted a number of questions today during the presentation, and I wanted to hand back to you to respond to those where is it appropriate for you to do so. Could I ask that you please read out the question and also say who it's from?
Okay, I'll do the reading, Gregor, and then do you offer or have you considered shareholder incentives, e.g. discount cards? No, we don't offer them, and we haven't really considered them, although I think if it was something that we felt that there was sufficiently strong demand for, then we would happily do so. I think it's interesting, our approach to discounts and things at a site level is, so we shy away from those little cards where you get 6 stamps and then you get a free coffee. And equally, we don't have an app where it recognizes it's your birthday and offers you a free glass of Prosecco. We see that as being quite a corporate branded approach. Our approach is we allow our teams to give away random acts of kindness, and so they're actively encouraged to give away free stuff. And that might be because someone's having a good day, it might be because someone's having a bad day, it might be for any number of reasons. And obviously we monitor it to make sure that it's being used responsibly. So that's how we deal with it from a customer point of view. And so loyalty is rewarded in a much more personable way. But from a shareholder perspective, I think we're very open-minded about it.
I think we are, yes.
Looking at the next question, have you experienced any supply chain issues that have affected your rollouts? That's probably the first part. Shall I let you answer that one, Gregor?
I think the quick answer to that is we haven't experienced any supply chain issues impacting the rollout. I think it's probably fair to say that we are taking care to make sure we're ordering further ahead in time to make sure that the rollout isn't impacted. To the extent that we're importing either furniture or fixtures and fittings, lighting fittings and so forth. So we're taking care there. I think where supply chain probably has impacted, and whilst it's not impacting at the moment, but certainly coming out of lockdown 3, the supply chain was quite heavily challenged, particularly on the drink side and the draft beer side, where the brewers had been, I think, pretty remiss in terms of getting their volumes right. And it was pretty difficult to get all the stock we wanted. But that has now certainly settled down, and we're very much planning for Christmas.
Would you consider adding new themes or brands to the lounge's offering? I guess in respect of themes, I guess I'm not entirely sure what that means, but we're constantly evolving, and our evolution is normally expressed in either the design and how our sites look, or it's expressed in the food offer and our food menu, or it's expressed in the drinks offer. So we don't really think in terms of themes, but there's that constant evolution. In terms of adding new brands, I think it's really important that we set out to the city and to our institutional investors back in April 2019 a strategy of opening 25 sites a year, and lounge and cozy club, and it's really important that we deliver on that strategy. And I think over the course of the last 2.5 years, we've demonstrated with COVID interruption that we're able to deliver on the strategy that we set out. And you consider the potential scale that we've talked about in the UK for lounge and cozy club, then we need to stick to what we said we were going to do. And there's an awful lot of opportunity for us out there. And hopefully that answers the next question, which someone suggested in their view, our offer would suit the American market, and have we considered this? And it's not something that we have considered, actually, no. It's, again, we're very, very focused on delivering that strategy that we set out at the time of the IPO. And just moving on to Matt's question in terms of when will we be ready to tackle expansion in Scotland? It's a really interesting question. So our approach to rollout is the business was founded in Bristol. We're sitting in Bristol today. And our expansion has been a gradual edging out, and as the years have gone by, we've headed further east and further north. And one of the lessons we've learned, I think, and we learned this back in 2013, is that if we jump to a new location and try and open sites there quite quickly, if we haven't got an existing trading business nearby, then we don't benefit from the support and the cultural strength of having lounges and cozy clubs nearby. So kind of jumping from one location to another makes opening these sites more difficult for us. So we see an awful lot of opportunity to open sites in Scotland, and we're very excited about opening both lounges and cozy clubs in Scotland. And I suspect over the next 2 or 3 years, then we will be trading in Scotland, but we want to get there gradually. And the next question, do you feel lounges is relatively resilient to likely squeeze in consumer discretionary spend over the next 6 to 9 months? If so, please provide some context. I mean, I start, Gregor, and then you add in at the end. In short, yes. We've talked about value for money and that being important, and it's really interesting at the moment, actually. We're clearly operating in an inflationary environment. We've just started tracking a lot more closely what's happening amongst other leisure operators across the UK. So we feel we're really close to how much other people are putting their prices up. But you just see it. You see it going into a coffee shop. You see it going anywhere that people are putting their prices up. And as the VAT reduction is removed in March, then I strongly suspect we'll see another round of price increases. And we don't feel under pressure to follow suit. And so we're in a great position of strength, and that we can see what others do and ensure that we represent good value for money in comparison to other operators. And I think, again, as Gregor has highlighted, I think the fact that we continue to grow, then when we consider margin pressure, then we've got the benefit of that leverage, the benefit of that scale. And equally, I think our experience of how the business traded in 2008 in the recession, I think is quite important. I think when discretionary spending is reduced, then people tend to stay local more, and that benefits us. I think, and rather than getting taxis and travelling into city centres, people are more likely to walk around the corners of their local. And from a lounge point of view, in particular, then I think it means we are very resilient.
Well, those, funnily enough, Nick, were the 3 points that I was going to. I suppose one which I didn't really touch on earlier was that the introduction of differential pricing, which we introduced in July, which I think historically Lounge had the same menu throughout all its sites, or all its lounge sites, with the same pricing throughout all those sites as well. And the introduction of differential pricing in July means that we now have 3 price bands, and I think it just will enable us to play a few more tunes over the coming months in terms of making sure that we've got the right pricing for the right demographic, and we're maximising our opportunity, but we're never straying too far away from those very strict value for money principles.
Nick, Gregor, thank you. I think you've addressed those questions you can from investors. And of course, the company will review all questions submitted by investors today, and we'll publish those answers on the Investor Meet Company platform. Nick, perhaps I could ask you to wrap up, after which I will redirect investors to provide you feedback. Yeah,
so just like to say thank you very much to everyone for joining us today. And just in terms of a wrap up, as we come out of COVID, I think every time the business has been allowed to trade, we've outperformed the sector, and we've demonstrated that our community-based all-day offer has never looked more relevant than it does now. We've used the lockdowns well. The business has continued to evolve. We've innovated. I think really importantly, we've got better from a customer perspective. And if I think about the property opportunities, they continue to be excellent. They were excellent pre-COVID, and they're getting better post-COVID. And that's allowing us to open better sites than ever. So as we look at the potential scale of the business, we've talked historically about 400 lounges and 100 cozy clubs. Our firm belief is that those numbers are really, really conservative, and that we're very excited about the opportunity that lies ahead of us. Thank you very much.
Nick, Gregor, thank you for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management can better understand your views and your expectations. This will only take a few moments to complete, and it's greatly valued by the company. On behalf of the management team of Loungers PLC, we would like to thank you for attending today's presentation. That now concludes today's session. Good afternoon.